Welcome, Ash,
Thanks for
to
having me.
another podcast of
Yeah,
Jazz TV.
sure.
Welcome to the show, and
Thank
thank you
you.
so much for taking the time out. For our audience, if you could please kindly give your introduction, who Ash is and
Yep,
what do you do,
sure.
an expert tax agent who's absolutely good at what he does.
Thanks, Jazz, for the warm welcome and for the invitation.
Thank you.
So my name is Ash Nadan. I run AMN Accounting, Tax and
Uh huh.
Advisory. So we do. It's a full service practice. We
Yeah.
do everything from your normal financials and tax returns. We look after different structures,
Yeah.
from companies, trusts, individuals, and people in different industries.
Yeah.
But also we do a lot of business advisory and transaction
Nice.
consulting. So it is a bit of a wide spectrum,
Right.
but very fulfilling. And I'm very passionate about what I do.
I can absolutely see, knowing you from so many years,
Yes,
I thought you would be the best person to give us some taxation advice
yeah,
and to our landlords and clients and
sure,
in general as well. We'll keep it really broad.
sure.
And if anyone needs any help, and they can always reach out to yourself.
Yes, more than happy.
Thank you so much, Ash.
That's
And
okay.
I suppose to sort of put a framework to today's podcast,
Yes,
the burning question these days is, of course, the taxes around real estate. Being a
yes,
real estate agent,
yes.
the question that comes in, but of course, we'll jump into it.
Mm-hmm.
Um, Tell us a little bit more about what's happening in the tax world.
Yeah, sure. Look, I think to start with, you know how they say death and taxes, but
Yeah,
we might throw real estate in the mix because it does go hand in hand with taxes
exactly.
sometimes.
So true, so true. I mean, you can't
um,
get away from them.
that's exactly, yeah. You try your best.
Exactly.
Sometimes they do catch up. So, look, I think one of the main aspects that you have to think about when you're buying a property is at some point you're either going to hold it for a period of time,
Time, yeah.
but there will come a time where you decide to rent it out
Yeah,
or sell it,
exactly.
or it could just be your main residence and then you decide to do something else
True,
in the future.
true.
So there are a lot of scenarios that we could run through.
Exactly.
To look at something that a lot of people think about is what happens when I
Mm.
sell a property.
Right.
And a lot of people, when they look at it, they go, okay, we have a property, I've bought it for an amount,
Yeah.
I'm selling it for this amount. What happens there to
Yeah.
that
Exactly. To
gain?
the asset, to the
So
gain. Yeah.
that probably brings us to the a discussion on capital gains tax.
Exactly.
So look, to just take a step back, if you have a client that is coming in and they've bought a property, as an example, the
Mm-hmm.
first thing that, if I'm in there, the first thing that I say to everyone is have a proper cost base
Yeah.
analysis of your property.
Right. Gotcha.
So, what does cost base analysis mean? So, it means to have a breakdown of the various elements that are included in a cost base.
Right.
So, there's 5 elements. The first one is, just your basic acquisition cost,
Uh-huh.
which is your contract price.
Right.
The second element is everything that goes with that,
The
the
expenses. Yeah.
expenses and everything else. So, if you have stamp duty,
Right.
you've got the PEXA, the
The
settlement
settlement
fees,
fees and everything.
conveyances,
Ah.
etc., etc. The third element has to do with any enhancements, etc., that you do with the assets,
Gotcha.
and then the other elements have to do with defending the title,
Right.
okay, of the asset.
Gotcha.
So all of those put together, once you
Become the
start,
expense.
becomes the cost base of the property.
Okay.
And the cost base of the property is very, very important. So you
Right.
need to make sure that you have all the expenses, that
Receipts.
the receipts and,
Yeah.
and everything. It's pretty simple nowadays because everything's electronic and you do tend to
Exactly.
have a copy of everything.
100%.
But just make sure that you build up that
Book.
worksheet as you
Yeah.
go. And that will give you a good understanding of how much a property actually costs you.
Right.
How many people do you know, and you say, hey, how much did this property cost?
Exactly.
And they go, hey, 500, that's the contract price.
Exactly.
But behind that 500, there's also maybe an extra 10% on top of
Correct.
that.
Exactly.
That has to do with
So
stamps
that
and
can be
everything else.
adjusted at the time of capital gains
That's right.
tax as
Yeah,
well.
exactly. So the more you have as a cost base, the lower your gain will be in the future.
So hypothetically, someone buys a property for, hypothetically, say 700,000.
Yes. Yep.
There's stamp duty of roughly 35 to 40
Yes.
grand,
Yes.
and then there's
Yep.
conveyances fee,
Yes.
bank charges,
Yep.
settlement fee,
Mm-hmm.
discharge, and all those sort of things.
Yes.
And then you decide to spend, say,
Mm-hmm.
50 grand on renovation of the property.
Yep.
So, and the property sells for 850
Yes.
in, say, 4 years' time,
Yes. Yep.
hypothetically.
Sure.
So your gain is not 150, it's actually 100,000
Yep.
because you've spent 50 on top. Plus, sorry,
Yeah.
you
So
kept your
yeah.
stamps and plus
Sure.
it takes
That's
you to
right.
800.
Yeah, that's right. So the sometimes, let's say just to go to an example, as you said, if you buy a property for how much did you say?
So 700.
700, and you've got costs of 100,000
Yeah.
on top. So that property has a cost base of 800, and if you
Right.
sell it for 800, you haven't really made anything.
Yeah.
So there wouldn't really be a gain that's accessible. You still
Right.
have to put it through in terms of working out what the gain is,
Uh-huh.
but there wouldn't be much. But let's change a couple of things here.
Please.
Let's say we have the property. You paid 700 for it, and you've spent your stamps, and you've done some renovations.
Yeah.
You've had some holding costs over the years, and let's just say it comes to 750.
Right.
Okay, and you sell it for 850.
Right.
All right. So now you have a gain of $100,000.
Exactly.
And that gain is your capital gain on the property.
Exactly.
Yes.
Wow.
Yep.
Wow. So that means this is a question for a landlord who is planning to sell now,
Mm-hmm.
and we have a lot of landlords in that situation where the properties say really run down at
Yes.
the moment.
Yes.
Now they've purchased hypothetically for 400,000 7
Sure.
years before,
Yes.
and it will help them to get a better price if they put in, say, depending on again if they have that much money disposable cash available
Yep.
for putting some money in, or they may find companies like Fix Sell Pay
Yep.
who would come in and then charge them at the settlement.
Sure.
Hypothetically saying, if they spend 20 grand or 30 grand now,
Mm-hmm.
it's a added benefit to get a higher sale price
Yep.
versus paying capital gains without spending that money and then achieving less money for the property in a sale price,
Mm-hmm.
but still paying a lot of tax as well.
Okay. So so there's a couple of variables I think in the scenario.
Correct.
The first one is we're assuming that the market will treat those renovations as and
Yeah.
you know the market, you understand it. So let's just assume that yes, the market sees those renovation as
As added
increasing
value.
the
Yeah.
value, right? Which it does most of the
Exactly.
time. So for example, if that were to add an extra 100,000 to the sales
sale price,
price, so that would mean that this person now has 100,000 extra,
Yeah.
and they've spent 20,000, but that 20,000 they'd added to the cost base.
Exactly.
But they do have a bit of an extra gain there that goes to their income
Right.
as well as an adjustment.
Exactly.
So yeah, it could definitely work in their favor,
Right.
depending on whether that comes out
Exactly. Because they will
well.
be adjusted to the tax, but again, they could potentially
Yes, yeah,
make a higher
they're going to
profit
have
share
more in their pocket in the end.
in
You're
the
right.
end,
Yep.
yeah.
Mhm.
Fair. So
Yep.
that means the cost base of the property
Mm-hmm.
can be done, say, can be accumulated or can be
Yep.
counted even 5 years down the line before selling,
So
or is it has to be when they purchase?
well, look, most people, most people that I see, they normally don't have the cost base worksheet,
Right.
and they really do it once they've sold the property
Right.
and they've come to someone for advice, and they
Yeah.
go, okay, what is my tax bill here, or what's my tax bill going to
Yeah.
be? With my clients, I do a tax planning session every year with the
Right.
majority of them.
Gotcha.
So we look at the events that will happen in their life.
Gotcha.
And sometimes they go, hey, Ash, I'm looking at selling this property.
Gotcha.
So the first thing that we do is we make sure that there is a cost base for the property.
Right.
And you do this at acquisition if
Right.
it's a client at the time. But sometimes,
Exactly.
they come
After
they've
purchasing,
purchased,
yeah.
and but you do build it up.
Exactly.
And so let's say if it's a property that they've held on for 10 years.
Yeah.
So as I said, we look at everything that they have spent on the
Right.
property. So we go back to the original sales contract.
Right.
We request a whole array of different information. Sometimes they do renovations and they
Right.
don't really have a tally of how much they
They
spent.
yeah.
So it's all about making sure you have all these invoices
Yes.
so you can build up that cost base nicely.
Gotcha.
I should say though that anything that you claim in tax, let's say you have an investment property.
Gotcha.
So, if you've claimed something in tax, then obviously it doesn't go against your cost base.
Right.
All right, so anything to do with interest, council rates,
Right.
your outgoings, they wouldn't go in your cost base.
Right. Gotcha.
Because the cost base is really something that you don't get as you
Right.
go. It's just something that once you
Makes
realize the
sense.
asset, then you have the cost base there,
Right.
and you can deduct it from your
From that.
proceeds.
Yeah.
Yeah.
Right. Right. Right.
Yep.
So again, it's a personal tax advice that depending on the
Yep.
earning of that person, whether they should offset on the income, or they should not, and then use that at the end.
Yep. So the most people obviously, if they've got, let's say, a property in their personal name,
Right.
they would be able to claim the expenses against
Right.
their income. So 99% of people do that.
Yeah.
Now, if you have a different structure, let's say you have a trust,
Yep.
for instance,
Right.
you buy the property in the trust, the property sits there, you have these expenses that you claim every year. But if there is a loss in that year, you can't use that loss and put it against your income because
Right.
it's trapped in the trust
Gotcha.
until such time as the trust is positively geared,
Right.
and then you can use those tax losses to offset those
Right,
income,
right, right.
based on the trust deed and all the other tax laws that are involved. But look, it just depends on the structure. But if it is an individual person, they would just allocate that against
Right.
their negatively geared property. And then once they have a capital gain, there's still a significant amount which will be the cost base.
Right.
Say if they've done renovations, but they haven't claimed that over a certain period of time. So that's something that we look at as well. Let's say if you buy a property and it's a brand new property, we obviously recommend that you get a depreciation schedule
Yeah.
to make sure that you're claiming those things, but that
Exactly.
reduces your cost base. So if you
Correct.
claim it in tax, your cost base reduces accordingly.
So
Yeah.
yeah, okay. That's interesting. That's
Yes,
really
that's
interesting.
right. Yep.
So, in terms of capital gains taxes,
Yes.
how does it? What exactly it is
Yes.
for the ones who are potentially looking at buying investment?
Yes. Yep.
When it comes into effect, when they get charged,
Sure. Yep.
and is it different for people living local in Australia
Yep.
or perhaps living overseas?
Okay, sure. So look, we'll just take your questions one by
Please,
one,
one by
okay?
one, yeah.
So capital gains tax, as I said, it's a tax that you remit based on any gains that you've made on capital items,
Right.
which we talk about houses here. So
Gotcha.
if you sell a house and you make a gain,
Right.
then there's going to be CGT, a CGT event that is triggered on
Right.
sale. So that's the first question you had. Now, the second question was to do with whether there's a difference if
Between,
you're foreign and if you're local.
Local.
Absolutely. So
Right.
from 2012, there used to be, and once we talk about the different concessions that are
Right.
available, but say for foreign residents, as you might be aware, they from $0, they from the first dollar that they earn in Australia, they
Right.
get charged 32 cents. So it's just the reality of it. So that's the first difference. They don't have that threshold that
Yeah.
we do as a tax-free threshold. So that's the first thing. Secondly, they used to be able to access a 50% discount on disposal of an asset.
As an asset,
They
okay.
they don't have that. So since 2012, they
Things have
don't
changed, yeah.
have that. Things have changed, and they don't have access to this. So whether they've held it for a year, 2 years, 3 years,
Right.
from 2012, you have to. The whole thing will be accessible, and there's no
Exactly.
discount. So
Right.
realistically, the main difference is in concessions and rates of
Gotcha.
accessibility.
Right.
Okay.
Right. Right.
Now, what was your last?
The last question was in capital gains
Yep.
taxes. I guess what is the best way
Yep.
to sort of be prepared
Sure.
for capital gains
Yep.
taxes?
Yeah. Sure. So look, it goes back to the saying that if you don't prepare and you don't plan, you're setting yourself up sometimes to
Yeah.
not have the result that you're hoping
Gotcha.
for, or for failure. So the first thing is planning. Planning is very important.
Yeah.
And I say this to most of my clients, you need to be able to prepare for these
Yeah.
events because they're major things.
Correct.
You don't want to be signing on the dotted line and
Exactly.
realizing, hey, why did I buy this in a company?
Exactly.
So realistically, the planning starts before you
Before
buy.
you even think of
Before you
it.
buy. So
What they say is, Failure to plan is a plan to fail.
That's right. That's right. So look, you need to have a think about the, sometimes you rush into
Mm,
getting into a property,
exactly.
before considering the different
Exactly.
structures and the different avenues that you
Yes.
have to make sure that you've optimally
Mm-mm-mm.
planned for
Exactly.
this. So I think before acquisition, you do a
Yeah.
lot of planning.
Correct.
And from there, if you're sitting down and you're looking at a property that's selling for 540,
Mm,
right there, when you do the cost-based analysis, you're going to be 540
mm.
plus,
The
A, B,
stamp
C, D,
duty.
and
Yeah.
E. Then you're going to be, oh, actually, it's going to cost me this much,
Yeah.
and my rental yield, will be.
X
I
percent.
thought in
Yeah.
my mind it was going to be 6, but now when I put that in,
Purchase.
it's
Yeah.
actually 2 or 3.
Exactly.
So you can balance all of
Yeah.
those, and I think there you can go. Okay, is this the right
Correct.
one, or maybe I should
Look for
probably
something
look for
else.
something that
Yeah.
has a better yield,
That's a
or
really good thing you said because at the end of the day, we get a lot of clients who end up buying a property
yeah,
and they call us saying,
mm-hmm,
I'm about to settle a property.
yeah,
I would like to advertise this for 700 a week.
sure,
I said, great. But when we do the numbers,
yes, not
the
realistic,
comparables are sitting at 450,
yes,
500,
yep,
520, for an
yes,
example.
yep,
And when and most of them are either from interstate
yes, yep,
and they've purchased a property over a FaceTime inspection, or
sure,
perhaps they've sent a friend
yep,
over, and they were advised by the estate agent that
mm,
they could potentially get somewhere around 650 to 700. Happens a lot of times.
yep,
So I suppose a message to a potential landlord or an investor purchasing the property is to go online
yes,
and even
yep,
do a bit of a research to
sure,
see what similar properties are asking for
yep.
in that area, because at the end you're going into competition with them as well.
Absolutely, yeah. I
So
agree with you there. I think it's a very important thing that you
yeah,
do that research. Sometimes there is a big fear of missing out as
exactly.
well, and people, they would try and jump in.
Correct.
But I think before you jump in, take a step back,
Yeah.
have a think, because this is an asset that you're investing in,
Correct.
and you should really take your time and
Mm.
consider your situation
Exactly.
and whether that yield will really work for
Correct.
you. Because once you buy it, it's great, everyone's
Mm.
happy, and once the returns start trickling in, you realize, hey, based on my cost base,
Exactly.
my yield is actually 2-3%,
Person, yeah.
and that's when there might be some issues
That maybe the
that
suburb is
happen.
not right for them for investment as well.
That's right. It
Yeah.
just depends on their situation,
Exactly.
and I think doing the basic work at
Exactly.
the start
Yeah.
can save you a lot,
Correct.
but also it makes you more informed. And
100%.
this is not the only deal that you might do in your lifetime,
Exactly.
and it just prepares you to be better for the next
And I
one and
think
the
right
next
deal
one.
can actually help you accelerate in your portfolio as well.
Yes,
And
absolutely.
the wrong
Yeah,
asset could
yeah,
actually hold you back for 10 years.
yes, yeah. That's true.
Yeah.
Sometimes you think about people buying, say, apartments,
Mm.
and they think, look, I'm going to have the capital growth
Yeah.
plus I'm going to get the yield.
Correct.
But most of the time, you get the yield because the
Mm.
capital growth is not there or it's negative.
Exactly.
Um, so you just have to think about the asset class, etc.,
Exactly.
that you get in.
Correct.
And sometimes if you've got the financial planners that are helping you with all these things, it does help you a lot.
Exactly. You gotta take
Yeah,
advice from the
you
professionals.
have to get the advice
Yeah.
where you can, where it's relevant for
Exactly.
you. And I think with property and with CGT, as I said before, it is
Exactly.
all about planning, and
Gotcha.
you plan probably before you sign on that dotted line.
100%.
Yes.
And I suppose keeping the records, like you said, is really critical.
Yes. Yep.
And
Absolutely.
utilize those for the end
Yes.
as well.
Yes.
So,
Yep.
with regards to
Yep.
the next question that I have is what an investor from
Yep.
overseas
Sure.
should keep in mind, because many of the times
Yep.
people would come at the time of selling,
Sure.
and then while the property is in the market,
Yep.
they say, I'm not too sure what sort of taxes I'm up for.
Sure.
Or at the
Yep.
time they're about to accept an offer
Yep.
as well.
Yeah.
And then we ask them a question that,
Mhm.
haven't you had a decision or
Yep.
a discussion with your tax agent or
Yes.
tax accountant or
Yes.
professional?
Yep.
Sometimes they say, do you have someone you can recommend?
Yes.
And they haven't taken any advice
Sure.
previously putting it
Yep.
on the market.
Mhm. Yep. So I think again, this is what I qualify as an event that we need to have a
Mm,
meeting, a catch up about.
exactly.
So essentially, what I would say is we'd look at we'll have a chat to the agents, get a range of the property. Let's say you say, hey, it's going to sell between 800 and 900. So what I do in the background, I go, okay, this is my cost base. We've done that when we first, you first became engaged with us. We did all of that, and then now you're selling. So, Jazz is saying, hey, it's going to sell between 8 and 9.
Yeah.
So what I do is I do a scenario where there's a sale price of 800,
Gotcha.
scenario where there's a sale price of 850 and one of 900, and then we have all the costs, we have the selling costs as well that we add on top, and then we go, okay, if you sell for A, B, C, or D, this is what you're looking at in terms of a total gain, and this is the concessions that you have available, and this is what your capital gain will look like. So then when they get an offer, and I tell you, we're doing these on even numbers like 850, 900. Most of the time, it's going to come in
exactly in double
858. That's right. It's going to come in. People have these 999 things.
Yeah, exactly.
So look, but knowing at a midpoint where your tax and where your where the total gain will help you make the decision quicker, and at least you know what you're up for.
And I think it's easier for a client to sort of then jump onto a right offer as well.
Yes.
Sometimes the highest offer is not the right offer. Sometimes it's what helps them save the tax as well. Is that right?
Yeah, that's right. Look, I think at the end of the day, the more you get, the better it is for you, because if you get $1, at the worst case scenario, you have to give 47 cents to the tax man, right? So the rest is better in your pocket.
Fair enough.
Yeah. So look, if they have a high offer, obviously you will work with them with the conditions of that offer and how that fits in their scenario. Because sometimes, as you know, sometimes the conditions can make or break a deal. And the tax is something that we can forecast, but sometimes the final selling price or the conditions is something that you sort of have to work through with the clients as well. Yeah, so just to go back, like we can predict what the total number will be, so you can know, hey, what's my next purchase going to be, for instance. If you're selling and you're thinking, hey, I'm going to get all these gains and then I can plow this into the new one, well, think again, because part of that has to be remitted for tax. And most of the time, the people don't know until such time as they're lodging their return, because they haven't had the conversation. So again, these events have a... Yeah.
How does that... Something just came to my mind when you said some people would not plan or would not... They'll realize it later.
Yep.
Property sales.
Yes.
As an investment.
Yep.
When is someone liable to pay that tax, like straight away? Does it get deducted automatically, or you have to lodge it?
No, sure. So it depends on the person's lodgement dates for tax. So let's say they have a lodgement date because they're with a tax agent, it's the 15th of May. And this maybe goes back to planning as to when you sign the contract, etc. So let's say you sign the contract on the 29th of June, you're selling. Yeah? Now, you've done that on the 29th, it's in that financial year. You'll have to pay the tax on that when you lodge the return and when it's due and payable normally, in the next financial year, so 15th of May in the next year. Now, if let's say you've signed the contract on the 1st of July, new financial year, it's assessable in that financial year, so the gain is really payable, let's say, 18 months after, if that makes sense to you. So you get assessed, but then it's due the 15th of May the following year. So a day can give you an extra, like 18 months of oxygen to use.
That's why a lot of landlords will come in, of course, and say, we would sell after a certain date.
That's right, yeah. But at the end of the day, we do have to reconcile that with the 50% discount concession. So if you held the asset for 12 months, that's another big consideration with a lot of people.
Yeah, let's talk about that.
Yeah, sure.
Again, that's 12 months or less is
yes,
also
yes,
something
sure.
talk
So
about.
before we get into the 50% reduction, I just want to maybe run through
Please.
some of the concessions that are available as well. So, okay, we know you have a gain. All right. Now, what do you do there? Do you pay tax on the whole of the gain, or are there things that are available to you? So, the first thing, I think the first and foremost is if it is your main residence, and this is the main residence that you've elected to use, and you've ticked all the boxes in terms of you actually live there, your address is there, you're on the electoral roll, you've got all the utilities, etc., etc. Normally that's your main residence and it's exempt. You do have to say, look, I sold this property, but then you say it is exempt because it's the main residence exemption. Now, I do qualify this as well because you do have residences that maintain the main residence exemption for a period of 6 years from the time it was your main residence to, let's say, I'll give you an example.
Let's do a year and someone purchased in a year. And
yeah, that's right. So, you purchase a property and you live there. Okay.
So now, let's say 2010.
Yeah, let's say let's say 2010. You purchased the property, and you actually get a call in 2011. You get a job offer in Sydney.
Sydney,
right? You bought in Point Cook.
Yeah.
So you're like, okay, I have to go and live in Sydney, so I'm gonna rent up there. So I'll rent out the property over here.
Yeah.
Okay. Now, once you do that, it starts earning assessable income.
Correct.
And you put that in your return. Hey, I'm getting X amount of rent. These are my expenses. And in 2012, that position was a contract and they offer you a permanent position.
Right.
Now, once they offer you that permanent position, you're like, oh, what am I going to do? I want to buy a house in Sydney, close to the water. So I'm going to have to sell over here.
Gotcha.
All right. So once you sell that property over here, in your mind, you're like, oh, I've earned income on it, so don't have the main residence exemption.
Right.
But there is a 6-year period whereby you could move out of the property, rent it out, but then you have 6 years in between that where you can decide to sell and you'll still be eligible for the main residence exemption.
Okay. Wow.
So, again, once you do have these events happening, before the sale happens or before you sign the contract, you can think about those, and then it helps you because you have a better outlook on things.
Yes.
You're becoming more proactive rather than just reacting to a prospect of a big tax bill.
Exactly.
So that's the main residence exemption. Now, flowing through from this, you also have the 50% discount on the sale of a CGT asset.
If you live there for 12 months.
So so if you've hold on, like say you've held on to the property for a period of longer than 6 months, it doesn't matter if you've lived there because you could be renting it out.
Exactly.
If you got a rental, you bought it in 2018, and then you hold on to it till 2020, you'll be eligible for that 50% discount. So if you have say you've got a property and you've sold it and you've made a gain of 200,000, you bought it in 2018 and you sold it in 2018, that'd be a really big gain to have, but anyway, that will be 100% accessible, less the cost base, etc. The gain is there, but if you held on to that property for 12 months, then you get a discount. So the accessible amount is really 100,000 at that point.
Right.
Okay, so these are just some of the concessions that are available.
And the other question that comes in
Yep.
is someone moves out.
Yep.
So they were living there for 3 years.
Sure.
Then they moved out, they had their children's education, which is quite common right now.
Yep.
People move to Ballarat.
Yep.
To a different school.
Sure.
And they go there for 3 years, they're renting a property there.
Yep.
And they rented this house for, say, 2.5 years or 3 years.
Yeah.
And they start living back.
Yep.
And then 3 years later down the line, they decide to sell.
Yep.
Some people would think then, if they live there for 2 or 3 years, and that's a question that comes in, I don't have to pay capital gains tax. Which is, I believe, of course. Yeah,
sure. So look, so the main residence exemption, as I said before, each time during that 6-year period, it resets.
Okay.
So if you move back in and this is your main residence, you haven't elected any other properties to be, then you don't lose that exemption.
Right.
Okay. So
you don't have to pay capital gains.
Depending on their specific situations, you wouldn't have to. In that case, let's say if everything else was constant, they wouldn't have to.
So depending on again the structure and
Yeah, if they move back in, it's their main residence, no issues.
so even the last 3 years they've made income on the property.
Yeah, that's fine because it's the same as you know how we had the scenario
Yeah.
about the person moving
Correct.
interstate.
Yes.
It's the same thing. He's never moved back in, but he's still eligible for that because you know it was his main residence to start
Right.
with, but he
Gotcha.
has that period of time,
Fair.
and it does reset over time. So you
Right.
do want to move back in for a few months, you know, but everything has to be a
Yeah.
genuine move back.
Exactly.
Yeah.
Exactly.
So it's not just about getting a
just moving in.
yeah, that's right.
And I
Yeah.
suppose rather than assuming things, it's best to sort of have a professional on your side like yourself
Yep.
to ensure that they actually understand their personal situation
Yes.
and
Yes.
what's beneficial for them in their situation as well.
Look, I think the most important thing is to make sure that you educate yourself on every aspect,
Yeah.
because it is a big purchase.
Correct.
So the more you read, the more you understand things,
Exactly.
and if you have a good advisor on your side, it's only going to help
Help
the
and benefit
process.
you, yeah.
The advisor will come to you and will
Correct.
give you the advice, and then you decide whether you want to,
Exactly.
run with that advice
yeah.
or you want to do something else.
Exactly. So
We,
true.
so
true.
we prepare our clients for the best,
Yeah.
and then they still have that, that
Exactly.
that bit of a gap between what we say and what
Of course.
happens, but we try and narrow that gap down so they understand
Yeah.
all the consequences of everything.
Exactly. Wow.
So look, planning, Jazz. That's the most important
Exactly.
thing, and sometimes the event happens, you have
Right.
you have a bill at the end, and you go, oh, why is my
Why
tax so high?
that's
That's
so
the big
high?
question.
Yeah.
But you need to plan for it.
Exactly.
You see a
And
lot
be
of people.
aware of it without giving, rather than having a shock at the end.
That's right. Sometimes it's better to know
To be
something's
prepared.
coming. You be
Exactly.
prepared, and then you can put something aside.
Exactly.
You can go, okay, I've got this thing there. I
Correct.
might not buy
Yeah.
the latest car I want. I might just
Exactly.
maybe hold
Just
off
wait.
and
Yeah.
clear that, and then
Exactly.
I'll know whatever I have left over is
Correct.
something I can use.
Interesting. And Ash, what is your advice to anyone who is about to get into an investment?
Okay. So look, I was going to say call me and we can do
Yeah,
the planning together.
definitely. Absolutely, that's critical.
Yes, yeah. No, look, I think to go back to just just you need to think about things, take a step back, um, make sure that you educate yourself,
Mm.
you learn about the different aspects. I understand, looking at your videos online, you do a lot of education.
Yeah.
You try and the knowledge that you have, you don't just keep it to yourself,
Yeah.
you try and give it to others so they
Exactly.
can make informed decisions. And when you need to step in as their advisor, as the person who's going to guide them through that process,
Exactly.
you're there all
Exactly.
every step of the way. But the client is aware of what he needs to be on the
Exactly.
lookout for.
Correct.
So I think that's one of the main things. Educate yourself
Yeah.
about what you're doing. Secondly, plan for everything. Understand the different elements of an acquisition,
Exactly.
what costs are involved. Do a budget for everything.
Right.
But more importantly, what I say to people is even though you have one property, get whether you do it in a spreadsheet, there's a whole array of different software
Exactly.
out there.
Available, yeah.
You could just get the lowest subscription possible,
Yeah.
put your investment property in there,
In there, yeah.
and then have all the costs just go.
Correct.
Have a separate bank account.
Exactly.
The rent comes in, you reconcile it to the
Yeah.
rent account, and then have
Exactly.
a whole array of different expenses. And then, yes, it costs you a little bit of money,
Exactly.
but when you get to tax time, you don't need to scramble to get
Correct.
your receipts. It's all there. You can
Yeah.
upload all your receipts and everything else in there.
Right.
So all about planning, making sure you have the right controls in place,
Gotcha.
and yeah, just keep learning
Keep
about
learning, yeah.
things as you go.
Exactly.
Yeah,
Exactly. Thank you so much for your
it's
time,
my
Ash.
pleasure.
It's absolutely beneficial. I'm pretty
Yes,
sure people will get a lot of value out of it.
sure. Yep.
And I would recommend everyone and anyone who's got any questions regarding
Yes.
tax
Yep.
and property
Yes.
should reach out to yourself.
Absolutely, I'd be more than happy to assist.
Yeah.
And see what a little, what some planning, what
Absolutely.
difference some planning can do.
100%, especially we have a
Yep.
lots of overseas investors that we look after,
Yes. Yep.
and they own properties from Singapore, Malaysia,
Yes.
and China, and the
Yep.
different countries around the
Yes.
world.
Yep.
A lot of investors are in Point Cook,
Mm-hmm.
a lot of them,
Yes.
and I would definitely be recommending everyone to have a tax planning done well in advance,
Yes.
because a
Yep.
lot of them seem to come in the market at the moment.
Yes. Yeah. No,
Yeah,
of course. And look, the the earlier you plan and you start the
exactly,
process, the better prepared you'll be.
100%.
Because a lot of the vendors out there, they don't do the planning, and if you do it, you might be a step
Mm,
ahead of them because it
exactly,
might make your decision quicker,
exactly.
and it makes your life easier as well because
Mm,
you're not guessing and you're not going into these
correct.
other things. Because sometimes you sell and you're just wanting to get into something else, but then
Mm.
you need to consider how much cash flow is actually available for this
Exactly.
purchase.
And if you have anything left over or not
That's right.
as
Yeah.
well.
Yes. Yeah.
So that's
Exactly. Hopefully you do, but
hopefully you do, yes. I mean, depending on the time you hold the property, I'm pretty
yes. Yeah.
sure.
Yeah. Yeah. That's right. Yeah. It depends. Look, that's the thing with property. Like sometimes
Mm,
there are instances whereby there's and maybe something that we could touch on
mm,
is if you do have something called, we've only spoken about the positives, which is the
right.
gains, but there is also the loss side of
Mm.
things. So say if you are unfortunate
Okay,
and
let's go through
it
that.
could happen
Yeah.
whereby you have a property
Mm.
and at the point in time you sell it, you actually have a capital loss.
Yeah.
So when you have that capital loss, you can't offset that capital loss against your ordinary income.
Right.
Let's say you have a salary of 100,000 and you
Right.
have a cap loss of 100 grand. You might be thinking, "Hey, I've lost here. I've worked here.
Mm.
I'm getting a big refund this
Right.
year." But no, that capital loss can only be applied to capital
Gains
gains.
tax. Right.
Yeah. So you need to wait until such time as you have a new gain, and then you
Uh-huh.
can apply it against that loss.
Right.
That's one thing I think that's important to highlight as well. They are
Right.
crystallized until such time as you can apply it to the right
Uh-huh.
income class.
Right.
Okay,
Right.
or in this case, in the right capital class.
So you normally don't, of course, there's no capital gain, so you don't pay any tax on it.
No, yeah, absolutely. You
Yeah.
don't pay tax, but let's say you've dusted yourself off,
Mm.
you bought another property, and you've decided to do some planning,
Right.
and you've you've decided to get some advice, and now you're more prepared, and you
Yeah.
get into it. You actually do another purchase, and you're successful
Mm.
this time around, and you have a $200,000 gain. So
Yeah.
in that time, then that $100,000 loss will go against that.
Right.
Okay, so it reduces your gain by the amount of the loss.
Then it's
Okay.
ideal to buy another investment.
Well, look, I wouldn't recommend like I can't really recommend people buy things and all that. I think it's really their
That's more of
prerogative.
financial
But I'm
advice.
just exactly that we're getting into financial advice. I don't and I think the important thing here is understand, hey, I can't apply this
Mm.
to my income,
Right.
like my personal income,
Right.
etc., but I can definitely use it for capital gains in the
Right.
future. And I think just one more thing before we do just a couple of things that I
Please.
thought about is a lot of people out there with the popularity of Airbnb.
Mm-mm. Oh
As
yes.
you know, it is quite
It's plenty
popular.
in Point Cook as well.
Yeah, that's right, and it's I think it's only going to grow
Mm.
in popularity in the future, and it's allowed people that had an extra space
Right.
in their
Correct.
house. Like say if they've got they've just two
Mm.
parents and their kids are all moved out, and
Yeah.
sometimes they rent out a
A room.
room
Yeah.
or a space. So just bear in mind that that has implications.
Okay.
As soon as your property earns income and you're still living there,
Mm.
how I said if you move out, etc., that
Right.
wouldn't apply if you're still living there and you
Gotcha.
rent it out. The portion of the house that is attributable to Airbnb
Right.
income will be part of a CGT
Right.
assessment because you'll have to work out that proportion,
All
and
right.
then that
Isn't
won't
it
be a main
confusing?
residence. It is.
Two, four-bedroom house, one bedroom is
Yeah.
getting Airbnb income, and how would
And,
you?
and
How?
imagine if you've got, okay, now let's make it interesting. You've got the four bedrooms. What about the spaces, the communal spaces?
Mm.
How do you factor that in? How do you go, okay, I'm renting so
They're
it's
using your kitchen at night.
that's right. So it's all about if the predominant use. Let's say you have 4 bedrooms,
Mm,
you're one, and you use one, but then you rent out all three.
right,
Then the majority of that house would actually be income producing.
right.
Even the communal spaces, you'll still have to do a ratio. So it does get confusing. Once you
Wow.
start doing spreadsheets about this, you'll go, okay, you've got bedroom 1, 2, 3, and 4, you've got the common areas. This is the percentage that it's been used for
Wow.
365 days. So it is a, a bit of a calculation, but to go back to basics, you will lose a portion of your main residence exemption
Right.
if you do rent out, say on Airbnb, etc., because you're income producing.
Mm,
The same goes for if you have a business
right.
that, let's say you work from home.
Yeah.
That's not really a business. You're just working as an employee.
Right.
But if you do have specific sections of the house that you've bannered up, it's all,
Yeah.
like your company logo there. You've rebuilt it so it's just for
For
business,
business, yeah.
then that will affect your main residence exemption as well.
Right.
So sometimes it's better to rent somewhere
Gotcha.
and just keep your main residence as it is,
Yes, yeah.
because not paying tax on a gain,
Exactly.
on a large gain, is better than paying some rent for
Exactly.
some time. So again, depending on your situation
Fair enough.
and what you have, you do need to consider all of those
Exactly.
things. Yeah, so a lot of variables, but we do try and help you along the way to
Exactly.
to take the confusion out of everything.
One last thing, if you don't
Yes,
mind me
sure.
asking, is say, for an example, someone purchased a property.
Yep,
Of course, they 6 years and before concept.
yep,
Bought a property in 2020, sells in 2022.
yep,
Capital gains tax, buys in 2020, sells in 2020 in 6 months' time,
yep,
less than 12 months.
sure. Yep.
Higher or lower?
Well, I think we've got to work out how much they bought and how much they sold for.
Okay.
I think that's going to be the first thing. But
Okay.
assuming, the one where they held for longer, if the gain is constant, let's say it's 100,000 in scenario one and 100,000 in scenario two, it's always going to be better in scenario one because you've held it for longer,
Right.
and then you get that 50% discount.
Right.
In the first scenario, 100% will be accessible. In the second one, only half.
Right.
So again, just running through the scenarios as you
Right,
go,
exactly.
that takes away some of those questions.
Right.
And also, sometimes hanging on for a few months, you get the rental income,
Exactly.
you've got the expenses, you can offset, etc.
them as well.
It's sometimes better
Yeah.
than just rushing off. Again, depending on your situation and whether
Exactly.
you have to fire sell,
Correct.
depends on person to
situation,
person.
yeah.
Yeah. So yeah, I think that
Wow.
that answers it there.
Exactly.
Yeah.
Now,
Sure.
thank you so much. That was very detailed, but
Sure.
again,
Yep.
of course, we haven't delved into anyone's personal, obviously, taxation
Yeah. Yeah. Yep.
requirements.
Yeah. Sure.
But suppose
Yep.
if someone really wants to reach out to yourself,
Yep.
you're more than welcome to look after. Of
Yeah.
course.
Yeah. Absolutely. Yep.
And
Yep.
we'll actually do another session. It was really
Oh,
informative.
I'd be more than happy. Look, there's a few things that come up
Mm,
every year. You've got the budget, and you've got the law changes,
exactly.
the tax law changes. So I'm more than